Are you thinking about buying long puts? Trading options can be a very lucrative activity, but this kind of financial derivative isn't something that you can just jump into without researching first. There's a lot of strategies to cover, with each one building upon the previous to create even more complex trading strategies. For this video, however, we're going to be talking about one of the core strategies for options trading, the long put. Okay, so let's jump right on into it. Options trading are essentially directional bets that allow investors to profit from neutral, bullish, or bearish markets, depending on the strategy. So, long put options offer investors the opportunity to profit when an asset declines in price. A long put option is a contract that gives a holder the right but not the obligation to sell an underlying asset at a predetermined price or a strike price within a specified period, which ends at the expiration date. This underlying asset can range from stocks and bonds to commodities or even currencies. Investors who purchase a put option, they pay a premium to acquire this right, and they're known as the buyers or the option holders. The people selling the put option and receiving the premium, well, they're known as the sellers or option writers. Now, if you want to know more about selling put options, check out this video up here. Okay, so the premium is determined by various factors, and that includes market price of the underlying asset, its volatility, time remaining until expiration, and to a certain extent, the current interest rates. The buyer of a put option hopes to profit from a decline in the underlying asset's value by selling that asset at a higher price than what it's actually worth. By holding these contracts, investors gain leverage as they have control over significant assets with just a fraction of the money. And if the prediction comes true and the asset price falls below the strike price before expiration, well, in that case, investors can exercise their right to sell it at a higher value than the current market price, and they realize a profit. And that's really the whole point of this channel, investing in a way that makes you money while also protecting your losses. And if you like videos about this kind of stuff, well, go ahead and hit that subscribe button. That way you'll never miss any of my future videos. Okay, so long put options also serve as valuable risk management tools for portfolio protection. In times of uncertainty or anticipated market volatility, investors may buy long put options on assets they already own to limit potential losses if those prices drop significantly. So it's kind of like buying insurance on your car. When you buy car insurance, you pay a premium. And if you get into an accident, well, the insurance policy pays. But if all goes well and you don't have a claim, well, you lost your money that you paid. You lost the premium. So you could say that buying put options creates an insurance-like position that offsets any declines in your existing holdings. Again, it's important to understand that long put options are typically purchased by investors who expect a decline in the underlying asset price. In order to start, you'll purchase a put option contract to initiate your long put position. Each contract represents 100 shares of the underlying asset, and it includes 4 things: the underlying asset, the strike price, the expiration date, and of course the premium. Now, if you're used to trading stocks, chances are you might wonder if long put options sound like short selling stocks. After all, they're both bearish strategies and both profit from an asset's price decline. However, there's a few key differences between short selling and owning long puts, and let's get right into that. The first and most important difference between the two is the risk or level of exposure. Short selling involves borrowing shares and selling them right away at the current market price. And then you hope to buy them back later on at a lower price, and then you can return them to the broker. And of course, the difference is your profit. However, short sellers technically face unlimited risk if prices rise instead of fall. That's something to think about. On the other hand, long puts have their maximum losses limited to the upfront premium paid for the option. That's it. This can be much more attractive to investors and traders because they know what their risk is going to be. Let's say, for example, you have $1,000 to invest, and we'll compare short selling versus buying a long put. You could enter a short position for a stock that trades for $200, and if you short 5 shares, this means you'll borrow 5 shares from the market, and then you're going to sell them immediately for $200 each, or $1,000. If the stock's price moves down to, let's say, $195, well, you can close out your position by buying the 5 shares for $195 each, netting you a $5 per share profit, or 25 bucks. Of course, if the stock went over $200 and you had to close the position, well, you'd have to buy back the stock at the current price, which is more than you got for it. So let's say, for example, the stock went to, I don't know, $1 million. Well, then you'd have to pay $1 million times the 5 shares to close out the trade. Well, it wouldn't get to that, as you'd face a margin call well before, but you get the idea. Bottom line, short selling is probably the riskiest strategy out there. Now, let's consider buying a put option instead. Let's say a trader wants to invest, again, $1,000, but this time in a long put. And maybe this time they're going to pay $1.95 per share for the premium for the option with the $200 strike price, which is also at the money or the current price of the stock. Now, the trader controls 100 shares of that stock, and they only shell out $195, which is calculated by multiplying the premium of $1.95 times 100, since, of course, all equity options are equivalent to 100 shares. Now, if the trader wanted to invest the remainder of the $1,000, they could use the remaining $805 to purchase 4 more contracts, giving them control over 500 total shares, with another $25 to spare, maybe for, I don't know, an overpriced cocktail or something else. Anyway, now let's say the price moves down to $195. Well, in this case, the trader's total profit from the 5 contracts will be a whopping $1,525. And that's 500 shares times $5. And this is what it means for investors to have exposure to the asset at a fraction of the cost. Investors can also protect their positions or speculate on potential price drops by purchasing a put option. And here's some different ways that it can be employed in trading. Well, first, you could do a protective put. And a protective put is a hedging strategy that involves purchasing a put option on an underlying asset that investors already own. The purpose is to limit potential losses if the asset price declines significantly. By the way, check this video up here for more information about options hedging strategies. A long put spread involves buying both higher and lower strike priced puts simultaneously on the same underlying asset, but with different expiration dates or other variations in contract terms to manage costs and, of course, risks effectively. It allows investors to benefit from moderate declines in an asset's price, while, of course, reducing the upfront costs compared to buying, well, just one expensive long-term put option. This strategy might be a bit complicated to some, but it also deserves another video. Having fictional companies and scenarios can help with understanding how the long put strategy works, but some people might like it better to apply the strategy in real-world scenarios. Well, if that's you, we're going to do that right now. Options traders can use an option scanner to make it easier to find good trades or trades that work for them. And for this example, I like to use Option Samurai. I like it because it's got a really good user interface, which is perfect for beginners. But I also like to have all of the more advanced features because the option scans are fully customizable with dozens of filters for you to choose from. All right, so here we are at the main screen, and I'm going to go ahead and hit Compose a New Scan. Here we have the trading strategies, and I'm going to go ahead and hit long put. And as you can see here, we have all of the filters. Now, first thing I'd like you to point out is to see the break-even percent. It's set to -5%, and that's how far the stock has to drop for you to break even. Next up, I want to show you the expiration date, and we're going to pick something about 6 months out. There we go. And there we have it. So in this particular case, the stock has to drop more than 5% in order to break even. I'm going to go ahead and here and hit Run Scan. Now, here's all of our results, and all you got to do is look for something that you have in your portfolio. In this case, we have mostly ETFs. Now, I'm going to start right here with the first one on the list. It's the SPY. The SPY is an ETF based on the S&P 500. And for this trade, it's suggesting for you to buy the $434 strike price, and the current asking price is $11.72 a share, or $1,172 for the contract. But here's the thing. Notice the break-even point. It's only -4.61%. Let's look at the profit and loss. As you can see, it's showing that the SPY is currently trading for $442.71. And the break-even point is $422.28. And you see, the further it goes down, the higher your profit is. Now, you might wonder, if the strike price is $434, why do I only profit if the price goes below $422? Well, that's taking into consideration the $1,172 premium you already paid. Smart, right? All right, so let's look at another example. Maybe you own Visa in your portfolio. Well, in this particular case, they're suggesting for you to buy the $245 strike price that expires on March 15th for a price of $1,195. In other words, in this case, this one you'd actually be buying an in-the-money put option. And that's because we're not really concerned about the break-even point, if the money is in the option or in the money or not. All we care about is the break-even point, and in this case, it's only -4.32%. Now, if the stock stays above the $245 strike price, great. It might even go higher, and you'll be able to participate in all of the upside. But if it goes below $233, the break-even point, well, you get to participate in all of that downside. So there you have it. A long put option is a simple strategy that benefits from the decline of an asset's price. But it's an important basic option strategy that you have to master. You can use paper trading accounts to practice, or check websites like barchart.com for data, or Option Samurai to get the best options trading recommendations. Just don't jump into it with real-world money before you're completely comfortable with how the strategy works. Thank you so much for watching the video. Feel free to leave any questions or comments. As usual, I will be happy to respond back, and I hope to see you in the next video. Bye.